Let's assume a pension fund had 100 billion beginning January, funds under management. I mean, I'm not saying this is a perfect thing, don't get me wrong. I'm saying it's just a concept, right? So 80% return will give you 18 billion, yeah? 118, so 2%, that, the size of the fund will go from 100 to 118, and the fund manager will get 2.3 billion. That's the maximum fee they can earn anyway. Now, if we break it down into two funds, yeah, then it will be 80 and 20. 80 will earn 14, Abby. 20 will earn 1. So the total is 115.4. This is what they now earn. The difference between this and this is what? 52 million. That's a shortfall. What I now did was I said, okay, how much contributions do they need to make to offset that shortfall? 2.6. Is that 2.6 billion? Yeah. Or trillion? Yeah, 2.6 exactly. Which came to 0.07 of that 25% of the potential market that they have. In other words, it's not difficult to get it. Next slide. So what I said is at just 0.07 of that 25%, they're covered. In fact, at 2.5%, informal sector, 364 billion per annum, compared to the 2.6 that they're losing, okay, just by capturing 2.5%. So in other words, it actually is in the interest to use the housing to bring in the informal sector. That same person, 3 million per annum, yeah, saves approximately, when I calculate, about 15,750 pension per month. That goes to 108,000 naira per annum, okay? At 18% per annum compounded over 20 years, yeah? The person will retire with 36 million. That's what they will get, roughly, okay? Now, say the person had joined this, had opted for the housing fund. This is what will go into their 18, this is what will go into their 5%. So they've moved from having 18% to 15.4, a bit of a drop, yeah? So in other words, he's giving up some yield to be able to buy the house. Next slide. Okay, this is what happens. Original pension contribution per month, 15,750. Average annual return, 18%, you retire at 36. Okay? Now, let's look at option 2. Again, as I said, 15, we've broken it down, is 15. Now, this one gives 18, right? And therefore, instead of getting 36, the person gets 29 million. But guess what? They bought a house. Okay? The value of the house they bought was 10.5 million. Yeah? The mortgage loan was 8.4. Interest rate 9%. Annual salary 3 million. Mortgage rate a month 75. P is within the 33, so it's fine. Value of house, I think the value of property in 20 years, I think I assumed a 8 or 9% property inflation. Yeah? 58 million. The principal and interest that was paid for the period, 18.1. Net is 35. So, at the end of the day, yeah, because I gave up or 5% or whatever, my net worth is 84 million because I have a home that is worth 53 million, plus I have cash from my Pencom people of 29, which is there. Or I could have saved all my money in Pencom and come out with 36. So for losing this, I gained that. Next slide. So we put it all together, which I'm not going to go through the whole thing, but we put it all together. My question is that in my example, contributor could have retired with 36 million instead. He or she has 29 million and a house worth 33. What would you rather be, sir? And the beauty about it is what? Now, let's look at some benefits to stakeholders. From a government standpoint, significant increase in job creation. Yeah? Social system, all the things we talked about. Okay, stronger GDP, a home ownership culture, wealth creation, and then more importantly, totally private sector driven. There's no money from government. We're not asking for anything from government. It's totally private driven. the truth of the matter is, you can do as many agriculture funds or whatever you like, but you give a man a home, he never forgets you.